Good morning friends, welcome to The Point. In this video we shall try to understand what is the basic difference between a bank and NBFC. First we start with the definition of what bank is. So in the first slide, as you can see, there are two types of financial institutions. So what is this financial institution? Anything which helps in channelizing the resources or the money is financial institution, and they are of two types. So first is the banks, as we all know, as we have all heard of it, and the other one is a non-bank. So non-banks are these NBFCs. So first go through the definition of what banks are. So banks are those financial intermediaries that are involved in the function of accepting deposits and giving loan. So at one place what they do is they take money of the people who come in to deposit their money, and out of the money that get deposited with the banks, they create loan and give it in the market. The banks allow the citizens to deposit excess cash with them, as I told you, and in return provide them with certain rate of interest. With the money that comes as a deposit, banks create loans and give it to the people for various purposes like starting business, educational purpose, personal use, working capital loans, medical loans. There's so many types of it. So as per the demand, whatever a person has, they give loans. So the difference between the deposit and the lending rate is called net interest spread, and the interest spread constitutes the bank income. So I'll put it this way. So let's suppose there is Mr. A who has some excess cash with him, and he goes to SBI to deposit it. And in return, SBI will offer him 4% interest on this money deposited. Now what SBI will do with this money is it will give loan in the market to whosoever requires it at the rate 7% per annum, right? So here, as you can see, the bank is giving 4% to this Mr. A and getting 7% from Mr. B who took loan from SBI. So this 7 minus 4 is this 3%, and this is what bank's income or bank's profit is. So out of this 3% is how banks manages its expenses and runs its business. I hope it is clear. Next, banks classification in India. So there is commercial bank, small finance bank, payment and cooperative banks. Each of it we will learn in detail in the upcoming videos, but as of now the broad classification is this. And also there is a central bank, which we all know as RBI. Next is, what is this NBFC? NBFC, as it's a financial company, right? So NBFC is a company registered under Companies Act 1956, engaged in the business of loans and advances, that it gives loans and advances to the people, acquisition of shares, stocks, bonds, debentures, securities issued by government or local authority, or other marketable securities of a like nature. So it is not mandatory for these NBFCs to acquire shares or bonds issued by the government. They can also acquire bonds or stocks issued by some local authority or any other private company or whatever it is. So, but it is not mandatory for them to acquire it from the government or just by the GSECs. Leasing, hire purchase, they could be into insurance business, chit business, but it does not include what they should not be engaged in any activity which is related to agriculture, industrial activity, purchase or sale of any goods other than securities. So purchase and sale of goods mean trading. Let's suppose you're buying apparel from one place or sugarcane from one place and selling it at a retail price to another. So this is buying and selling of goods. They should not be into this business. Other than securities, as we discussed, they can buy it, but not the goods and services like apparels and machinery, or maybe sugarcane, rice, or paddy, whatever it is, or providing any services. They could not be into any service sector as well. And sale and purchase, construction of any immovable property. So they should not be in construction business, or say building of bridges and towers, or anything which is immovable, or some machineries which are installed and they are immovable. They should not be into that business. Their business should be restricted to whatever it is written here. Now, NBFC are also of two types. So this is deposit accepting and the non-deposit accepting one. So these NBFCs are allowed to accept deposit from people, and they have certain additional conditions which they have to adhere to. Okay, and these the non-deposit one. So the conditions are a bit relaxed as compared to the this deposit accepting and NBFCs, and all these are dictated or regulated by RBI. They define as to what additional conditions these NBFCs have to adhere to. And last is the difference between the two. What is the difference between bank and NBFCs? So now these banks are regulated under Banking Regulation Act 1949. And NBFCs, as you know, they have to get registered under this. It was mentioned before also. So now the loan sanction process, if you go to bank and you want to get a loan, so there are many formalities which you have to undergo. So the process is bit, you can say, strict, and it's more stringent, and it is more, it takes more time to avail loan from a bank as compared to NBFC. In NBFCs, the processing of loan is easier and faster. Next is product offering. All types of loan they offer. Let's suppose if it is working capital, medical, personal loan, business loan, education loan. But what they do is they usually do loans on property. Demand deposit, yes, definitely that is the basic how they earn. They take money, and then they on this money they give loans and earn interest, and then that is the income of the bank. NBFCs, as I told, there are two. This is deposit taking and this is non-deposit taking. So yeah, all of them doesn't go for this. This we are talking here about, if you see, is the demand deposit. No NBFC is allowed to take the demand deposits. They are only allowed to take the term deposit. Yeah. So interest rate benchmark, that's the base rate plus margin, whatever the spread is. So there are many ways in which the interest rate benchmark is set by RBI. So that is another topic which we will discuss later. But as of now, whatever the base rate is prevailing, plus whatever the margin wants, the banks want to keep. And now this is how do NBFCs decide their interest rate. And in case of NBFCs, it is RPLR, that is retail prime lending rate, and whatever spread they want to keep. Overdraft facility, yes, it is available with most of the banks now. It is wrongly mentioned. Most of the banks give it. With NBFCs, it is not available, and the reason, if you try to think that, it is that DDs or the demand deposits, they do not take it. So how could they provide the overdraft facility? Passing interest rate benefit to existing borrowers? No, because most of it go for the fixed loan. So yeah, they don't do it. Yes, in case of NBFC, there is a high chance that the interest rate benefits is transmitted very quickly to the new borrowers and the existing ones. And in case this prepayment convenience through NEFT, yes, you can pay to banks via this NEFT facility, but in this NBFC usually prefer this check clearing system to get the payment. Maintenance of reserve ratios, yes, it is very much compulsory for the banks to maintain the reserve ratio, which is CRR, SLR. All this is ensured by RBI to see if the banks maintain their liquidity. For NBFC, it is not compulsory. It is decided by RBI. Interest rates. Rate of interest will be comparatively low. In case of the interest rate which is being referred to here is on the saving account. So yes, also on the loan simultaneously. So the loan you get from banks, and this on the interest rate on the saving accounts is low if you compare to the NBFCs. NBFCs charges high rate of interest on loan, and at the same time gives high rate on the deposits which they accept. And the foreign investment, in case of banks, it is the ceiling limit is 74% in the private sector banks, but in NBFCs it is up to 100%. So these were the broad topics on which the banks and NBFCs are differentiated. You can go through it once again. So yeah, this is all for the today's video. Thank you so much.